Financial markets, financial assets, and financial intermediaries form the foundation of the global financial system by facilitating the transfer of funds between savers and borrowers. The program explains that financial markets enable economic participants to exchange financial assets efficiently, allocate capital productively, and manage financial risk. These markets support economic growth by directing savings toward investment opportunities that generate future income and productivity. Financial assets represent claims on future cash flows, while intermediaries connect surplus units, such as households and investors, with deficit units requiring financing. Understanding the interaction among markets, assets, and intermediaries is essential for analyzing investment opportunities, evaluating financial risk, and understanding how modern financial systems operate. Financial assets are legal claims representing ownership rights or contractual obligations. Common examples include equities, bonds, derivatives, bank deposits, and investment fund shares. Equity securities provide ownership interests in corporations and allow shareholders to participate in profits and potential capital appreciation. Debt securities represent borrowed funds that obligate issuers to make interest and principal payments. The program emphasizes that financial assets differ from physical assets because their value derives primarily from contractual claims rather than direct productive use. Financial assets also allow investors to transfer, diversify, and manage risk more effectively. Different asset classes vary in risk, return potential, liquidity, maturity, and sensitivity to economic conditions. Financial markets provide the structure through which financial assets are issued and traded. Primary markets facilitate the issuance of new securities, allowing governments and corporations to raise capital directly from investors. Secondary markets allow investors to trade previously issued securities, improving liquidity and price discovery. The program explains that efficient financial markets enhance economic performance by reducing transaction costs, improving information flow, and enabling more accurate valuation of financial assets. Organized exchanges, over-the-counter markets, and electronic trading platforms support these activities globally. Market efficiency and liquidity are especially important because they influence investor confidence, asset pricing, and the ability of firms to obtain financing at reasonable costs. Financial intermediaries play a central role in connecting savers with borrowers and improving market efficiency. Common intermediaries include commercial banks, investment banks, insurance companies, mutual funds, pension funds, and hedge funds. These institutions reduce transaction costs, provide liquidity, diversify risk, and improve access to financial markets. Commercial banks collect deposits and provide loans, while investment banks assist with securities issuance and corporate financing transactions. Insurance companies and pension funds manage long-term investment portfolios to meet future obligations. The program emphasizes that intermediaries contribute to financial stability by transforming maturities, pooling risks, and improving information processing within financial systems. Their activities support both economic growth and efficient capital allocation. Financial markets and intermediaries also help manage and distribute risk throughout the economy. Investors differ in their willingness and ability to bear risk, and financial systems facilitate risk transfer through diversification, insurance, derivatives, and structured financial products. For example, bond markets allow governments and corporations to borrow funds, while investors earn interest income according to their risk preferences. Derivative markets provide tools for hedging interest rate, currency, commodity, and equity risks. Financial intermediaries further assist by evaluating creditworthiness, monitoring borrowers, and reducing information asymmetry between market participants. Effective risk allocation improves economic efficiency by directing capital toward productive uses while allowing participants to manage uncertainty more effectively. A strong understanding of financial markets, assets, and intermediaries is essential for investment analysis, portfolio management, and economic decision-making. The program emphasizes that modern financial systems depend on transparent markets, efficient intermediaries, and reliable legal frameworks to function effectively. Analysts evaluate market structure, asset characteristics, and intermediary behavior to assess investment opportunities and financial stability. However, financial systems may also face risks such as market volatility, liquidity crises, credit failures, and systemic instability. Understanding how markets and intermediaries interact helps analysts identify emerging risks and evaluate the broader economic implications of financial developments. This knowledge forms a critical foundation for advanced study in investments, corporate finance, and portfolio management.